Hello, care leaders. My guest today is Michael Butcher, and today's topic is the spring statement's potential impact on the care sector. For those of you who don't know our guest, Michael is the finance director of Blackadder Corporation, a group of care homes with more than 200 residents. He's somebody that I personally come to for advice on how the economy relates to the care sector. This knowledge comes from being a chartered accountant and having a passion for data and analytics. Interesting things that you can expect to learn from this episode include Michael's expectation around the impact of the spring statement, how Michael and his team use data and analytics to improve the quality of care and to increase profitability, and which levers to pull to ensure commercial sustainability of the care that they deliver. My name's Simon Parker, and this is the Care Leaders Network podcast. So without further ado, please welcome Michael Butcher. Michael, you're a numbers guy and an accountant with limited fiscal headroom for the government at the moment. What are you expecting Rachel Reeves to prioritise in the upcoming spring statement?
It's got to be fiscal responsibility. A couple of reasons for it. First of all, if she doesn't get it right, the markets are going to turn on her and they are going to, frankly, do another Liz Truss moment, I think. We had a small shake in the markets in November. I think what's going on with the states at the moment and the tariffs is spooking the markets. We seem to be slightly exempt from it in the UK, but the EU is worried. The rest of the world is worried. We don't need a spring statement that affects that or changes anything. From a policy perspective, she's already trailed what she's going to be doing. It's the very exciting stuff of LLP structures. It's IR35, it's non-dom rules. It's all the stuff that us accountants get really excited about, and the majority of people go, I have absolutely no interest in that whatsoever. But I think it's just tightening loopholes and is frankly targeting more taxation take for the government. When it says we are completely focused on growth, what they actually mean is we need more tax take from whatever circumstances we can possibly get because there is so limited headroom in the budget and they just need to increase it. So a lot of it is, for me, is around, frankly, how do we use existing structures to increase the tax take, increase income, and therefore allow more spending on public services.
There will be some, of course, who say that that's an oxymoron in as much as the fact that the idea of taxing their way to growth seems like an oxymoron. Where do you sit on that? How does that feel for you as a concept? Do you think that they're doing the right thing by increasing the taxes in the various ways that they are, or how do you?
So I think. So they inherited a budget which clearly was tight anyway. I think that there's obviously a point at which we all turn around and go, well, clearly we should be exempt from national insurance increases because we're social care, and I'm sure the hospitality and the retail sectors will say exactly the same thing. I don't think they had a choice about where they could apply tax increases. I think their manifesto was naive, perhaps, to say here's where we're not going to tax, and so it's sort of limited to where they could tax. But I think I see the taxation to growth thing slightly differently. What I think the government's position has to be is we no longer have anything that is a manufacturing sector. We are fundamentally a service-based economy in the UK. That means that 80% of most companies' largest costs are wages, which means that if we can get growth in wages, then we will have a higher PAYE national insurance take. That means that we have to be able to sustain as a country higher costs because those revenues have to be charged somewhere. And that will mean not only higher personal tax and national insurance take home for the government, but also higher corporation tax. So that's the position I think they're trying to get to. I think they are trying to achieve growth in the economy, and the benefit of that to them is higher taxation in absolute terms, not as a percentage. I see that, I think I have to see that as a positive, because with a higher tax take comes higher spending available for public services, and frankly, more money into social care and into the NHS and into other partner services. So I see it as a net positive. I absolutely understand, though, that it is a pain on most businesses at the moment, and within social care, we're going to see providers fail as a result.
The evolution that care providers have gone on over, let's say, the last 5 years from COVID. We talked about this last time, I think, when we were podcasting. The idea of doing more with less, and using technology and driving efficiencies and all of that type of stuff. I guess the worry has always been for those that don't drive those efficiencies and look for areas of innovation and look to technology to be able to help them with that. Doing more with less concept, I guess it's more likely to be those that will end up in trouble. And unfortunately, it's the changing economic landscape is such that innovation, wherever it's found, needs to be adopted. And it kind of, I've got my my compassionate hat on for those that maybe haven't kept up with things, and it's going to cause them an awful lot of problems. But I mean, I've heard of from CEOs of care groups in every different category now, subcategory of care, that is, where there are businesses on the market that are available, like £1 deals, effectively, just to buy the to kind of buy the remnants of what was a business that's over leveraged and under capex spend and all of that type of stuff. And whereas in the past, people have, for the right deal, they've been quite bullish on those types of deals if they're good for a turnaround, if they like that type of stuff. Everyone that I'm speaking to at the moment is kind of going, whoa, there's too much. There's too much liability there as well. My worry when I think about that is, okay, but then who ends up running these care services if the owner's been kicked out because they're not covering debt service payments and all of that type of stuff? What implications does that then have on the people being cared for and the workforce and all that type of stuff? Which I think it's going to be an unfortunate byproduct of this whole set of circumstances, which is it doesn't fill me full of joy, I'm not going to lie.
Okay, so compassionate hat on first, caring hat on first. I absolutely agree. It is for the individuals employed by those companies. They're going to have to find alternative employment. They're going to, their services are in demand. We need carers in this country, so I don't think they'll be out of a career. But obviously, it's a wrench to leave a job. There's going to be disruption for the families, for the residents, for the people who are being cared for. That is going to be painful. On the other hand, though, and if I talk as a horrible accountant just for a minute, I actually see this as a positive for the sector, as an investment thesis. So I don't fundamentally what I think we're seeing here is that the demand for care services is static, if not increasing. More people require care. More people require more complex care across the whole of social care, from youth all the way through and children's services all the way through to where we deal with in 65 plus dementia care and beyond, actually, now. But what we're also seeing is the supply of services decreasing, partly for the reason that you've just said, that providers are going out of businesses and those assets are no longer being able to be traded. We're also seeing contracts being handed back to local authorities where they're not profitable. That's been happening in domiciliary care for a while now, but I think we're also starting to see it in elder person social care. I'm sure it exists elsewhere. We've seen the closure of end-of-life care and palliative care services. I think that's a consequence of how they're funded, and I hadn't appreciated how they are funded until quite recently. That is brutal and horrible, and my heart goes out to those services. That should never have been allowed to be the case, but those critical services are now falling away. So if supply of services static or at least decreasing, and we're not building any more care homes, that's another thing, by the way, then, and demand is increasing, then that's a good thing in macro terms for our business. Then put into the regulatory burdens that we have. And it's not only CQC, it's health and safety, it's gas safety, it's fire safety. Post Grenfell, that's tightened up like you wouldn't believe. I now know what a BS EN 1935 Type 13 hinge looks like. As a director. Well, clearly a failure on my part not to be on top of all of my hinge standards. But again, the level of knowledge that a director needs to have now to be in social care is absolutely phenomenal. And it's a barrier to entry. And we also have them in terms of the amount of money we need to spend to get into social care. Care homes are not decreasing in value. And for a new entrant to buy a care home requires, one, significant amount of capital, but two, a very friendly bank who is going to put some pretty onerous terms on you as a first-time owner-operator. So high barriers to entry, decreasing supply of competitors in the market, increased demand. As an investment thesis, it's a really good sector to be in right now. And not forgetting, we are recession-proof. In fact, I'd actually argue that it gets a little bit easier during a recession because the retail and hospitality trade lose staff, and we're able to pick them up with great backgrounds. And suddenly the chefs and the maintenance and the back office team, the activities team, fill up a little bit during that period. So, going back to your earlier point, it's brutal, it's horrible. We're going to see providers drop out of the sector. I think the next 2-3 years, my thesis is we'll see somewhere between 5 to 10% of care home beds drop out through either assets being mothballed or individual sort of units being mothballed. But as a fundamental investment thesis, I'm relatively bullish.
I can see that makes sense from an investment perspective. I think for the people who they haven't kept up to the times, either through being just passive to the set of circumstances or ambivalent towards the kind of the journey that is the care sector and all the challenges and all that type of stuff. I suppose for those people, then it's a bit of a shakeout, and probably the sector's better off without them. Like if you're gonna buy a care home because you want some passive investment, it's probably not the way you should go. Of course, for the people that put their lives and effort into running care services for many years and haven't been able to keep up for whatever reason, obviously that's a different set of circumstances. But your point around the shrinking of the capacity, whether it's 1, 2, 3, 4, 5, 10%, whatever it is, it ultimately that will limit the amount of capacity within the sector, and with growing demand, of course, that's it's the economics 101, of course.
Yeah, and the consequence of that is that there are going to be individuals who are unable to access care. I don't think that's the private sector. I think the privately funded individuals will always have beds available to them. I think the more complex NHS or local authority funded residents or people requiring care will always have access to it, because the local authority go, well, it's either us or the NHS who have to pay for it, and they can't be in the NHS and A&E forever. But you're going to end up with the local authority residential market as opposed to the residential dementia market. But the individuals who are on the lowest rung of local authority fees, who providers are going to turn around and say, well, it's not economic for us to provide for their needs. The local authority is saying, well, that's the fee rate, we're not going to increase it. So this individual just doesn't receive care. And that puts a huge burden on, one, families and unpaid carers, but also the more acute end of our public sector into A&E, into the police, into the ambulance service. And so it actually costs more when they're the lowest level of need for these individuals. They have more moments of crisis, and they end up coming in at a more complex position into the various care providers who are out there. So the system needs reform, and we've been saying this for years. It needs to be challenged, but the status quo is, if it's allowed to continue, I think the outcomes are really obvious.
Talk to me about the outcomes.
Well, it's the outcomes of just letting this roll are, one, you end up with local authority funded individuals who are not going to be receiving care. They're not going to be able to access it because providers won't provide it for low cost. You are going to continue to see providers exit the market. Frankly, a large number of providers entered in the 80s, 90s, 2000s during the privatization period. They are therefore of a certain age, 50, 60, 70 years old, and they're looking for retirement. Their kids aren't interested, or as an interesting consequence of the inheritance tax changes, can't actually afford to buy their parents out, or the parents don't want to sell out at the prices that would require. So you're suddenly looking at more trade exits or private equity coming in. The trade buyers are also looking to exit. HC1, Barchester, and the shareholders there are still looking to exit and still looking to slim, to realize their investment. So I think you'll see the top end of the market in terms of number of beds shrink in terms of the number of beds that they operate, and you'll have many, many more mid-market competitors with each other, more corporates in that space, moving away from the family-run independent one or maybe two care homes. I think you're going to see a large number of providers with somewhere between 4 to 10, maybe even 20 beds as a sort of a mid-market size. That will necessarily mean...
Sorry? You mean homes rather than beds?
Yeah, sorry, yeah. 4 to 20 beds. 4 to 20 care. Yeah, 4 to 20 beds. That would be a fascinating portfolio. You're then going to have more private equity and more debt in the sector, because if you have more consolidation, that's the only way it's going to operate. And as a result of that, you will have, if you look at this, and because I think that the market is going to move towards more complex levels of care, which is going to necessarily mean it's going to be more local authority and NHS funded. Not only that, but also because the private fee payers, people will start realizing, hang on a minute, I'm spending 75,000, 100,000, 200,000 a year on care. That's not going to happen. I'm going to manipulate mum's, dad's finances so that it looks like they don't have the assets. Sort of an inheritance tax planning, but actually care fees planning approach. Which, by the way, I have no idea why accountants haven't latched onto that. I would have thought that was a huge win for wealth planning, but that's a separate problem.
I was going to say there must be some geeky finance, solar type, qualified type people that are sat there thinking to themselves, how can we engineer this in a way that that's going to be good for our clients?
Yeah, genuinely, I've not seen that. I know there's a couple out there that who sort of talk about it on their websites, but it's not a huge thing in the accountancy practice market, which is kind of weird. But that's a separate conversation. So anyway, you've got this move towards higher fees in the local authority and the NHS sector. Because the market is therefore going to be more local authority NHS funded, you're going to see more of that public money exiting to go to the VCs, go to the private equity, go to debt payments. And I think there is a moral issue there that a government has to address. And let's just assume, for the sake of argument, that the current Labour government remains left of centre, argument that it's not, but let's just assume that they say that they are morally opposed to private equity and third-party banks getting rich out of the provision of social care. There is going to come a point at which they have to put a brake on and say, no, because the fees that we are paying into social care are increasing as an absolute number for whatever reason, this money, more money in absolute terms is leaving government pockets and is going into third-party wealth generation for, frankly, passive investment, either debt or private equity. That is not going to be acceptable, and they are going to have to reform as a result of that.
So I went for lunch, I don't know, 6 months ago with one of the big home care businesses, private equity backed. They saw a massive opportunity because of the scale of their portfolio to be able to fix some big NHS problems. Won't go into too much detail just in case there's any, I don't want to create any set of circumstances where I'm overstepping the mark. But there was a big problem and they could solve it. And to the extent to which they could solve it from an economic perspective had lots of zeros, lots and lots and lots of zeros. Mm-hmm. So, every good care provider should at that scale should try and do. They try to get a seat at the table with the government and to be able to say with senior ministers, here's a load of money that you're burning. We can literally solve this for you tomorrow. To which they said, yeah, that sounds really, really good. And then on this is in one of these. I can't remember what they call them now, but you can do like you can be hosted by the ministers. There's a particular name for it. I can't remember. So you're there with powerhouses of industry, and you're there chatting about all this type of stuff. So amongst the table, they said, "Yeah, that sounds great. Let's have a conversation." And then on the way out, it was a quick question to say, "Are you private equity backed?" And they were like, "Yeah." And they said, No, we won't work with you because you're private equity backed." And that was the end of the conversation. Literally, there was no response to that at all. So I think your point around the fact that it's probably going to happen, it seems like it's already happening.
Yeah, and that has implications for where the sector goes, because you cannot have an economic sector that cannot functionally transact within itself. So if you go back to the 2008 financial crisis, what sparked that off was banks basically not being able to trust each other, not being able to move money around, and you ended up with that systemic crash. If you look at the majority of industries where you have major consolidation, and airlines are a really good example of this, if Boeing and Airbus are fundamentally unable to continue to buy smaller suppliers and integrate them into vertical chains, or their supply chains aren't able to continually acquire and make changes, you end up with real issues in the production of the actual aircraft at the end of it. And it's because you end up in these positions of stagnant companies not really having much of a direction because the owners want to leave, or they go through management buyouts and the companies are so focused on paying down the debt that's accrued from that they're not actually focusing on innovation within the company itself. The company just becomes this debt-laden entity that just is static. It is very possible to foresee a future in social care, and I'm fast forwarding not even maybe 20 years, maybe even 10, where you start to get to this position, and it's not that we've got another Southern Cross, it's not that we've got another HC1, Four Seasons, private equity backed and not really doing anything, and completely all the revenue is going towards paying down debt. I think you're going to end up with a mid-market like that, which is in some form or other private equity, either family wealth or actual VC private equity, because we need to find a way of transacting everyone out of the sector, or for all the people who want to leave for the right reasons, because they're retirement sales and the kids don't want to pick it up. But if you're talking about care homes being worth 2, 3, 4 million pounds, and that's a mid-market 40 bedder, and you can only get, let's say, 1.3 million, I don't know many people at the moment who've got £700,000, if not more, to go, I'll tell you what, I'll buy my first care home. And I can assure